Let's bring in Marci McGregor now, Bank of America, Merrill Lynch. So, Marci, I mean, do you feel like we're still on shaky ground, or as we enter a new month, that we have a little bit better footing?
You know, when I push back a little bit, I see a market that's kind of treading water right near its year-to-date highs. We have inflation, which I think is going to come down pretty quickly over the next 12 months, but it's still more than twice the Fed's target when you look at core PCE. I think you have market breadth, as you were discussing, is pretty narrow. 70% of S&P returns so far this year come from 5 names, and earnings are declining year over year. So yes, I think in the near term, sentiment can kind of keep the market treading water. But the big question I have to ask myself is what will cause the market to break out of this really wide, stubborn trading range we've been in for months now? And I don't have a great answer to that. So I still see choppiness ahead. I do think the economy is slowing. And with market breadth as narrow as it is, much more narrow than it was back in February at the market highs, I'm still a little bit cautious on this market.
I mean, if earnings better than feared aren't a catalyst to take things higher, if a Fed pause this week isn't enough of a catalyst to take things higher, what is?
Exactly. You know, and exactly what the bulls are saying right now is, yeah, earnings aren't so bad. The companies are pretty resilient. The Fed is going to pause, but financial conditions are going to continue to tighten. I think we're going to get one more hike out of the Fed, and then they get into pause mode. They may leave the door open for June in their comments on Wednesday, but I think financial conditions continue to tighten. We haven't heard much about their balance sheet, and I think that roll-off is going to keep things tight. So I think, you know, I'm struggling to see, especially with kind of momentum kind of slowing a bit in earnings, what this looks like as we get to a debt ceiling argument in Washington, and as we get to a fall where I think the economy really will be slowing, and a consumer that's been so resilient, but I think the purse strings are starting to tighten. So I'm a lot more positive if I think 12 months out than I am 3 or 6 months out right now.
Gotcha. Josh Brown has a question for you.
Hey, Marci, thank you so much for coming on. What changes to asset allocations are you making in light of that outlook? Or is this really more of a behavioral thing where you're just kind of telling people don't have too much enthusiasm or maybe use too much leverage in the short term, make it to the long term because a year out things look better? Like, what's the right response to take if someone agrees with what you just said?
Great question. So our positioning all year has actually been neutral stocks, bonds, cash, because we do see that sentiment and light positioning can have a near-term impact. So we've said we're staying cautious, but staying invested. Now, we've been tilted towards defensives a lot this year. That's really only kind of perking up in the last 2 weeks. But I think it's going to be a wise way to be positioned for the path forward, especially as, in my view, earnings kind of continue to slow there. So it's up in quality, it's being defensive. And what I keep saying to clients is have your shopping list ready. When this cycle starts to pivot, it's going to look very different in terms of recovery. I think small caps will finally get their moment. International stocks will look a lot more attractive. I think it's a little early for those right now, but I keep saying have the shopping list ready and know where you want to position when this cycle starts to pivot.
Game out, speaking of pivots, game out Wednesday for me. Is a pause, maybe not so explicit, but implicit by the Fed, is that a sell the news event, or is that going to be viewed as a positive?
Listen, the view that the Fed pauses on Wednesday is widely consensus right now. The market is very much expecting a Fed to pause. So I think it's not really going to be a newsworthy event. Now, like I said, I think the Fed does leave the door open for June. They're going to have a couple more unemployment reports between meetings, another big inflation report. So they're going to say and tell us they're data dependent. But where I think the market is really offsides is when we're going to get our first cuts. The market's expecting cuts, I think, a lot sooner than reality. Our view is you don't get the first cuts until likely even early next year. And with that, you know, we have to remember markets actually react pretty negatively to the first Fed cut. Because why is the Fed cutting? The economy is really slowing. So that's where I think the market expectations need to be reset, is not on the pause that's coming after this meeting, not on the 25 basis points, but it's going to be on what the timeline is for a Fed cut. And I still think that's a ways away. Fed wants to be absolutely sure that they've battled inflation and won.